There are 5 income heads: salary, house property, capital gains, business and profession, and income from other sources. Let's talk about capital gains income from sale of equity shares and equity mutual funds. First, let's understand what capital assets are. These are possessions such as tangibles including land, building, vehicles, and jewelry. Equity shares and mutual funds are considered as tangible assets for income tax purposes, or intangibles including patents, trademarks, copyrights, etc. Now that we know what capital assets are, let's understand income from capital gains. For capital assets like equity and preference shares, debentures and government securities, equity-oriented mutual funds, etc., where STT is paid, if such assets are sold within 12 months of purchase, it is considered as short-term capital gains. If such assets are sold after 12 months of purchase, it is considered long-term capital gains. In case STT is not paid, like in case of unlisted equity shares, debt mutual funds, etc., tax treatment will be the same as that of any other movable capital asset. The minimum holding period to qualify for long-term capital gains is 24 months for other immovable assets and 36 months for other movable assets. Let's take a look at how to arrive at capital gains. To calculate income from capital gains from sale of equity shares and mutual funds, we need to understand buy value, that is the price at which you purchase the equity share or mutual fund; units, it is the number of equity shares or number of units of equity mutual funds; sell value is the price at which you sell the equity share or mutual fund; transfer expenses, including any expenses which are directly related to the sale of equity shares or mutual funds like brokerage expenses; STT, that is securities transaction tax, which is paid on listed equity shares and mutual funds. If STT is paid, indexation benefit is not available; indexation, it is used to adjust the cost against inflation to arrive at accurate capital gains. If STT is not paid, like in the case of unlisted equity shares, the treatment is the same as other capital assets, that is, indexation is applicable. In case of sale of equity shares and equity mutual funds, a major change was introduced in the Union Budget of 2018 regarding taxation on long-term capital gains. Long-term capital gains above 1 lakh rupees will now be taxed at 10% under Section 112A, which was earlier fully exempt under Section 1038. If you have purchased shares on or before 31st January 2018, the grandfathering rule will be applicable. As a result, the fair market value, or FMV, for shares bought will be considered for calculating the buy value. That is applicable if the equity was purchased on or before 31st Jan 2018 and if the capital gains income is realized from financial year 2018-19 onwards, that is from 1st April 2018. To calculate LTCG on shares purchased before 31st Jan 2018, buy value would be higher of the following: the actual cost, which is the purchase price, or the lower of the price as on 31st January 2018, which is the FMV, or actual selling price. The long-term capital gain is equal to sale value minus buy value minus transfer expenses. Any LTCG above 1 lakh will be taxed at 10% and STCG will be taxed at 15%. To understand this better, let's take a look at two cases. In the first case, you purchase equity shares worth Rs 2 lakh on 1st January 2018, and in the second case, you purchase the shares on 10th Feb 2018. You sold these shares for 3,50,000 on 10th Jan 2020 under both the cases. The capital gains calculation change under Section 112A of Union Budget 2018 will come into effect for financial year 2018-19. So this grandfathering rule will apply in case 1 since the shares were purchased before 31st January 2018 and income is realized in financial year 2019-20, and therefore we will consider FMV, which is the price of shares as on 31st January 2018 to calculate capital gains. FMV is 2,40,000 in this case. You can find the fair market value of the shares on the stock exchange website. The actual cost will be calculated in the following manner. Step 1, we will consider the lower of sale value, which is 3,50,000 or FMV 2,40,000. In step 2, to arrive at the actual cost, we will take the higher of either the value in step 1, which is 2,40,000, or the purchase value of 2 lakhs, which will make the actual cost to be 2,40,000. In case 2, because the shares were purchased after 1st February 2018's budget announcement, the grandfathering rule will not be applicable and the FMV will not be considered. Considering STT is paid, the indexation benefit is not available. To calculate the LTCG, we will subtract the actual cost from the sale value. which will be 3,50,000 minus 2,40,000, making LTCG 1,10,000 in case 1, and 3,50,000 minus 2 lakhs, making LTCG 1,50,000 in case 2. LTCG is exempt up to 1 lakh rupees. So in both cases, the LTCG that exceeds the amount of 1 lakh will be taxed at 10%, which is 1,000 in case 1 and 5,000 in case 2. If you have long-term capital gains from sale of capital assets other than house property, such as equity shares and mutual funds, vehicles, jewelry, etc., you can claim deduction under Section 54F, provided you buy or construct a new house property within 3 years of sale and not own more than one house property on the date of sale. To arrive at the exemption amount, you can use the following formula. The exemption is allowed under certain circumstances. Deduction under Section 54E, 54EA and 54EB are applicable when you invest the proceeds from sale of long-term asset into specific investments like government securities, units of UTI, etc. You can calculate the exempt amount by using this formula if the new asset is not sold within 3 years from the date of sale. If you are not investing into the new asset immediately under Section 54F, 54B and 54, you can deposit the amount from the sale of capital asset into a capital gains deposit account scheme. The capital gains account can be opened in some banks authorized by the government. Now that we understand the deductions applicable for capital gains income, let's see how it's taxed. STT is usually paid on equity shares and mutual funds. Therefore, the capital gains income from equity shares or mutual funds are taxed a little differently. In case of short-term capital gains, the tax rate is flat 15%, and in long-term capital gains, anything above 1 lakh rupees is taxed at 10%. In case of unlisted equities where STT is not paid, short-term capital gains are taxed at the applicable income tax slab rate, and long-term capital gains are taxed at 20% with indexation. For other capital assets, short-term capital gains are taxed at applicable income tax slab rates, and long-term capital gains are taxed at 20% with indexation and 10% without indexation, whichever is lower. If you have a loss from the sale of capital assets, you can set it off against any income from sale of any other capital asset, and the remaining balance of the loss can be carried forward for the next 8 financial years. You can adjust this carried forward loss against any future capital gains income you earn. But there are certain conditions. Short-term capital loss can be set off against both long-term and short-term capital gains. However, long-term capital loss can only be set off against long-term capital gains. To calculate these incomes from capital gains, you need documents like trading statements from brokerage for equity shares, mutual fund statements from the AMC, and in case of other capital assets, you need statements like purchase and sales agreement. In case of income from capital gains, taxpayers usually file ITR 2. The due date to file ITR 2 is 31st July. In case you file the ITR after the due date, you cannot carry forward your capital loss. You can show your income from capital gains and details of capital loss while filing for your income tax return. Subscribe to our YouTube channel for more such videos. We are Quicko, on a mission to simplify taxes for all.